For decades, investors have been trained on a simple mechanical relationship. When the Federal Reserve cuts interest rates, bond yields fall and risk assets rise. It is Wall Street's oldest heuristic, but it just snapped. This chart tracks Federal Reserve policy against the bond market. The blue line stepping downward represents 175 basis points of consecutive rate cuts. The yellow line represents the 30-year Treasury yield, and despite aggressive cuts, it is surging in the opposite direction. In fact, right alongside these rate cuts, the 30-year yield tagged a 19-year high. Relying on the old playbook right now will leave sophisticated investors exposed to massive drawdowns. We're operating inside a new macroeconomic regime. The baseline cost of capital is being rewritten by a collision of three structural forces. The first is a continuous streak of elevated prices. We have seen 64 consecutive months of inflation sitting stubbornly above 2%. The second is a physical capital expenditure cycle driven by artificial intelligence, which is actively raising the floor on economic growth. The third is a deliberate move away from the centralized signaling of previous decades toward a model of decentralized voting and intentional ambiguity. Accurately pricing the cost of money today requires abandoning historical assumptions and building a new model from the ground up. A 5% interest rate environment typically chokes off liquidity and drags the economy into a severe recession. We need to look at why that hasn't happened. The answer is found in corporate fundamentals. S&P 500 earnings are growing at nearly 30% year over year. Sweeping earnings performance reflects the actual, physical construction of massive technological infrastructure. This bar chart compares domestic spending categories to show the scale of this capital expenditure. On the left is the entire annual budget for the U.S. Defense Department. The bar on the right represents the combined capital expenditure of the major tech hyperscalers. At roughly $1.2 trillion, private tech infrastructure spending dwarfs the national defense budget. We can see the scale even at the individual company level. Alphabet alone is allocating $190 billion to its AI build-out this year. Compare that corporate allocation against a major nation-state military effort. Alphabet's single-year budget is higher than Russia's entire annual military expenditure for the war in Ukraine. This data center construction translates directly to macroeconomic metrics, specifically nominal GDP, the combination of real economic growth and the rate of inflation. Because of the AI spending cycle and the sticky inflation we noted earlier, U.S. nominal GDP is floating between 5 and 6%. The most efficient state for an economy is when the baseline cost of money roughly matches that nominal growth rate. If interest rates sit at 1% while the economy grows at 6%, any below-average investment can easily turn a profit. That dynamic incentivizes malinvestment and mindless speculation. A Fed funds rate between 5 and 6% forces capital to be disciplined. It penalizes poor allocation while rewarding true productivity. The current AI build-out has elevated nominal GDP to a point where 5% rates are a necessary filter to maintain market efficiency. The institution tasked with managing that 5% baseline is the Federal Reserve. For decades, the Fed operated under a centralized model. A single chairman would formulate policy in private and dictate the final decision to the markets. Successive chairs expanded this approach by relying heavily on forward guidance, using unified dot plots and highly structured communication to telegraph exactly what the future cost of money would be. The fatal flaw of forward guidance is that it creates intense moral hazard. Financial institutions begin treating central bank estimates as ironclad promises and adjust their leverage accordingly. The collapse of Silicon Valley Bank illustrates this perfectly. They loaded their balance sheet with unhedged, long-duration assets, relying entirely on the Fed's promise that inflation was transitory and rates would stay near zero. The incoming regime under Kevin Warsh explicitly rejects the practice of forward guidance. This diagram represents the old dictatorial model of the Federal Reserve, a single, unified signal transmitting policy to the market. Under Warsh, the institution operates more like the Supreme Court. It is fracturing into 12 distinct, independent voters, each prioritizing different economic data and fighting for their own policy views. We are already seeing the results of this shift. The Fed has recorded 10 dissenting votes this year, a level of internal friction not seen in decades. In a single recent meeting, 3 dissenting voters simultaneously pushed to hike interest rates against the majority consensus. Warsh refuses to provide a unified rulebook for how the Fed will react to incoming data, leaving the market to guess which metrics matter most. Because the central bank will no longer make promises, investors can no longer blindly trade forward guidance. They must now independently model the reaction functions of 12 separate policymakers. This lack of Fed handholding is currently playing out in the fixed income market, which is trying to navigate a persistent inflation regime. When inflation runs hot, bondholders face a severe mechanical threat. The fixed cash flows of long-term bonds rapidly lose their purchasing power. The bond market has developed its own reaction function. If the Federal Reserve cuts short-term rates while inflation is still elevated, bondholders panic about currency debasement. To escape that debasement, investors aggressively sell off their long-term bonds. That heavy selling pressure is exactly what drives 30-year yields sharply higher. The reverse scenario is entirely counterintuitive to the old playbook. If the Fed hikes rates, it signals to the market that it is actively defending the currency. Once bond traders trust the currency is being defended, they stop panic selling, prices stabilize, and long-term yields drop. This is the ultimate paradox of the Warsh era. To bring long-term interest rates down and save the bond market, the Federal Reserve actually needs to keep short-term rates high. Institutional capital must adapt its allocation models to survive this high-rate, high-growth environment. The massive capital expenditure numbers have convinced many that AI is a bubble about to burst, drawing comparisons to the dot-com crash. This chart visualizes the technology adoption curve. While the AI sector will eventually face a correction, current capital outlays place us in an environment equivalent to 1997, with substantial room to run before hitting the peak of inflated expectations. Structuring for this cycle requires balancing risk against debasement. This dashboard shows a defensive posture, 60% S&P 500 and 30% gold. The final 10% is a dynamic liquidity sleeve. Allocating this to floating-rate treasuries avoids duration risk while capturing a 5% yield. When quantitative volatility signals break down, managers must aggressively shift this liquidity, ruthlessly cutting exposure to high-risk assets to avoid catastrophic drawdowns. The era of trading on the assumption that bad economic news will guarantee a liquidity bailout is over. Success in this macroeconomic regime requires identifying genuine physical economic growth and actively outrunning financial repression without relying on the Federal Reserve to save you.